Hello, before we start today's video, just a quick note that if you are interested in purchasing this indicator, just simply email us at daytradinggps@gmail.com to request a discount promo code. In return for you taking your time for watching this video today, you can email us and request a discount promo code that will give you a substantial discount on the purchase of the indicator. All of our indicators are sold on a one payment for lifetime access basis. Thank you. One more thing before we get started, you'll see in the description of the video there will be this section here, which is click on this link for descriptions links to the other videos mentioned in this preview on different topics about the SPX indicator. So this is a Google Drive link. I'll show you where it takes you to now. So when you click on that link for the Google Drive, this is where it takes you to, which as you'll see is a list of different topics and links to the videos on the specific topics. These topics go into more detail. We may reference some of these topics very briefly in today's video, but when we reference to go look at the video that provides more details, then you'll just simply click on this link and go to here, and then you'll be able to click on the link that you want to see a more detailed video on a certain topic. Thank you. Hello, in today's video we'll be taking a look at the Friday, November 14, 2025 trading session for the SPX index. We'll be utilizing the Day Trading GPS Daily Key Levels indicator, specifically the V2.0 version of this indicator, which came out a few weeks ago, to trade SPX 0DTE index options. Okay, so in this particular video it's going to be a lot shorter than our normal video. We're not going to go into all the details about how the indicator works and some other aspects of the indicator. So if you would like to see a more full session and full details on how the indicator works, simply look in the description of this video and you'll see links to other SPX trading session videos, which are between an hour and a half long each, and you can look at those videos to get a more full details about how this indicator works. Also, there is a Google Drive link in the description as well that will take you to a Google document which has links and descriptions to specific topics on this particular indicator, which if you click on that link you'll see various different topics that are gone over in more detail. And if you'd like to see that, just simply click on the Google Drive link in the description of this video. Okay, so the way this indicator works is that it works on the TradingView platform, and it gives you the updated daily key levels at the first tick of the SPX open at 9:30 a.m. Eastern New York time each trading day that SPX is open. The most important of the key levels that the indicator gives you is the bull bear KPL level, which for today is 66.6734. So after analyzing recent days price action in the SPX as well as overnight and pre-market action, current market dynamics, and volatility, the indicator's several proprietary algorithms come up with the bull bear key price level for today's session as well as the other key levels. The bull bear key price level represents the initial bias level of the session. So above that level is bullish and below it is bearish. However, that is the initial bias for the session, and that bias can change. So if price continues to go in one direction, or price can change and go above the bull bear key price level as it did in today's session, and then we're flipping over to a bullish session bias. So what the bull bear KPL represents is the all-important bull bear pivot for the session. Bearish below and bullish above. The other main key levels on this indicator are the R1 through R6 levels above the bull bear KPL and the S1 through S6 levels below the bull bear KPL, which you can see here in this table display. Now the reason we don't have all 6 levels above and all 6 levels below showing on this chart is because it's better to drill down at the beginning of the session to see a more granular view of the levels, and also because that during the first part of the session, the bull bear key price level is going to be the most important level that we're going to look at, and generally speaking, it would be that level up to R2 or R3 and then down to S2 or S3. So for example, if you have all 6 levels showing, then you would have this. And so the reason for drilling down is because of this concentration of levels here that are all very important between R2 and S2. So all you do is you take your mouse and you go over to the price axis on the right side and go up, and then that allows you to expand out the chart so you can see a more granular view. With this indicator, you can take both bullish and bearish trades off of any of the main levels. So the main key levels, again, are the bull bear KPL level and the main R1 through R6 levels and the main S1 through S6 levels. These midpoint levels that you see and these QL levels serve different purposes, and they're not for taking trades off of. Only the main key levels, the bull bear KPL and the main S and R levels, then are meant for taking trades off of. Now you also see these other levels here, which are also displayed on this table here. You have, and we'll go back out here so you can see one of them. YDH is yesterday's daily high, so that is specifically the previous day's RTH session high. YDC is yesterday's daily close, that is the previous day's RTH session close. YDL is yesterday's daily low, the previous RTH session's low. PMH is the pre-market high, and PML is the pre-market low. Now we're going to be showing you 2 different trades today. One is a bearish trade and one is a bullish trade. Before we get to those trades, one important note here, we have a significant gap down from the yesterday's daily close and yesterday's daily low, YDC and YDL. As you can see here, YDC, PMH, and YDL, so the pre-market high, yesterday's daily close, and yesterday's daily low, are stacked one on top of each other, all in the same zone. So this is a clue that there is a significant chance at an attempt at a gap fill at least the closest of the 3 levels here, the closest being YDL being the closest to the gap down level. So keep that in mind. This is why these levels are also very important, because they can help you in the general context of the session. And then also keep in mind that any significant move upward is not only going to have candles start closing above and holding above the bull bear key price level, but also above the pre-market high. Conversely, any move with significant downside is not only going to have to start closing and holding candles below the bull bear KPL level, but it's also going to have to start closing below and holding candles below the pre-market low. Okay, so now we're going to move into the 2 different trades. So we'll go to our next screen. Okay, so here's our first trade of the day. It is a bearish trade. We have the 9:30 a.m. opening candle of the session marked off here. We're on a 2-minute chart. The 2-minute chart time frame is the recommended time frame for the daily key levels trading strategy using this indicator. However, the recommended chart time frames are between 1 minute and 5 minute. So if you prefer a different chart frame, then you can adjust the strategy accordingly to those time frames. However, the recommended time frame is the 2-minute chart time frame for this particular strategy, which is an intraday, intra-session day trading strategy utilizing SPX index calls and puts. So we're buying calls on bullish entry signals and buying puts on bearish entry signals. Okay, and as you will see, and if you watch any of our other SPX session videos, you'll see that the 2-minute chart is the chart time frame that we consistently use within that 1 minute to 5 minute range, as we have found it provides the most consistent results for this strategy. Okay, so here we have the 9:30 a.m. opening candle. As you can see, it opened above the bull bear key price level. However, it crossed below it inter candle and closed below the bull bear key price level. So this is your bearish entry signal on this 9:30 a.m. opening candle if you wish to take this trade with this indicator. The 9:30 a.m. opening candle trade is part of the daily key levels trading strategy. However, it is an optional part of the strategy. Many people that use this indicator prefer to let the initial shakeout pass. That initial shakeout could be anywhere from the first 5 or 10 minutes up to the first hour, depending on the trader. Some traders prefer letting the first hour pass by for the first hour of the opening range. Other traders prefer just getting the first 5 or 10 minutes out of the way. And of course, other traders like taking the opening candle trade. So in this case, if you are taking the opening candle trade, this is the bearish entry signal for a trade off of the bull bear key price level, because it is closing the opening candle below the bull bear key price level. So it doesn't matter that it opened above. What matters most is where is it closing. So conversely, if this candle had opened below but closed above, then we would instead be looking at a bullish entry signal on the opening candle trade of the 9:30 open candle. Also, this candle is within the acceptable range for a trade off of the bull bear KPL of where exactly it is closing. Excuse me. One of the videos in that Google Drive link is on the topic of 9:30 a.m. candle trades to avoid, despite the fact that it opens and closes above or below the bull bear key price level. So I would invite you to take a look, open that Google Drive link and go to that video and take a look at that. And there's also an accompanying PDF document to that video which goes over the details of what is within the acceptable range and what is outside the acceptable range. And those acceptable ranges also apply to trades taken off of other main R or S levels below. So either the R levels above or S levels below, as we said earlier, that you can take bullish or bearish trades off of any of the main levels with this indicator, those main levels being the bull bear KPL, the main R levels, and the main S levels. The midpoint levels and QL levels, as we'll explain here in a minute, have different purposes and they're not meant for taking trades off of. Okay, so this candle is within the acceptable range. This candle, just for your own edification, is not within the acceptable range. So if you take a look at that document, you will see that this candle here, even though it's a down candle, if you miss this trade here, this candle is out of range. If this candle had closed more in this area here, then it still would have been within range and you still could have taken a trade off of that candle. However, this candle is out of range. This candle is within the acceptable range. And on the close of this candle, you had 3 different option strikes that you can use. With this particular indicator, for any bullish or bearish trade off of any of the main levels that you wish to take, there are always going to be 3 different option strikes that you can consider for that bullish or bearish trade off of any of the main key levels. One is going to be the standard play, which is going to be an at-the-money option at a strike price that is closest to that level's price. So as an example, this trade is off of the bull-bear KPL level. The price is 66.6734. SPX trades in 5-point strikes. So for example, here, one strike would be 66.70 and one strike would be 66.65. So 66.6734 is closest to the 66.65 strike. So the standard play for this bearish trade on the close of this candle, closing below the bull-bear KPL in the 9:30 a.m. opening candle, is going to be the 66.65 SPX 0DTE put option. Now with this indicator, you can also use 1 DTE options if that is your preference. But just keep in mind that whether you're using 1 DTE or 0 DTE, in either case, you're going to be opening and closing your positions all within the same session, because this indicator is meant for day trading only. It is not meant for swing trading, because every day you're going to get a new bull-bear key price level and new updated R and S levels. So therefore, it doesn't make any sense to use options that expire a week from now, because then you're paying a lot for time value on options, which is completely unnecessary if you're just holding on to a position for a few minutes or for a few hours and opening and closing them in the same session. Okay, so with this particular indicator, as I said, you have 3 different strikes that you could consider for any bullish or bearish trade opportunity off of any of the main key levels. So we went over the at the money, which is the standard play, the 66.65. So how do you figure what the other 2 options would be? Okay, so how you figure that out with this indicator is you simply look at the level that you're taking the trade from, in this case the bull-bear KPL, the direction of the trade, it's bearish, so we're going to look down. You go to the first midpoint below the level you're trading. In this case, that's this level here, this midpoint level, and that is 66.5783. So that is between the 66.55 and 66.60 strikes, and 66.5783 is closest to the 66.60 strike. So that would be your first out of the money strike that you could consider if you prefer that over the at the money. What is the furthest out of the money strike you can consider on this trade? So the third option, which is the furthest out of the money you can consider, is a strike that is closest to a level that is 1 full level away from the level you're taking the trade from. So in this case, the bull-bear KPL level, the level we're taking the trade from, we look 1 full level down, 1 full main level down, and that is the S1 level, 66.4831. That is between the 66.45 and 66.50 strikes, but it is closest to the 66.50 strike. So that would be your furthest out of the money strike you can consider. Anything else past that is too far out of the money. Okay, now let's look at the prices. On the 66.65, it is 28.90 on the close of this 9:30 a.m. candle. The 66.60 is 25.80 and the 66.50 is 21.61. If you're not familiar with how options work, you take the price that you're paying for the option, multiply it times 100, and that is your cost of one option. So in this case, we're just buying options. We're not doing spreads. We're not doing iron condors. We're not selling options. We're not doing any option combination trades of various exotic types of spreads or anything like that. So we're simply buying put options on bearish entry signals and buying call options on the indicator's bullish entry signals. So in the case of this one, for example, 2161, you multiply that times 100, and so your cost of one of the 6650 0DTE put options is $2,161. This one would be $2,580, and this one would be $2,890. It's important to note that these options are more expensive than they would usually be due to the severe gap down we had and the increased volatility and the increased implied volatility on the options today. In a more normal volatility environment, these would be priced less. Okay, so there's two different types of trades you can take with this indicator. One is a scalp trade. The other is what we term a regular trade. A scalp trade with this indicator, you're looking for a one level move in your favor for a 100% closeout, no matter how many contracts you're trading. If you only got one option, or whether you have three options, or you bought 5 or 10 or 20 or 40, on scalp only trades, you are closing out 100% of your contracts. You're not scaling out, you're not adjusting your stop loss, you're simply closing out all your contracts at the 100%, at the one level move, closing out 100% of the contracts. So keep in mind the initial note in the indicator, in the video today on this indicator, of the significant gap down and these three levels here that we pointed out that were all in a row here in this compressed zone. So even though it's not a guarantee that we're going to have a gap fill based on the fact that these are three so close together up here, the odds are a lot better for a gap fill when you see something like this, where you'll have yesterday's daily close as well as the pre-market high and yesterday's daily low all compressed together, stacked one on top of each other. So that's one thing to keep in mind in taking a bearish trade off of this gap down, even though it's closing below, that the odds favor a gap fill. That doesn't mean there's a guarantee that we're going to get a gap fill, only that you need to keep in mind that a gap fill, the odds for it are a lot better when you see something like this. Okay, so on the very next candle, as you can see here, it not only sliced through the pre-market low, but it actually hit the one level target for a scalp here, wicked slightly through it, and closed slightly above it. So again, how you figure a one level move in your favor is you take the level that you're taking the trade from. What's the direction we're taking the trade from? Down, since this is a bearish play. One full level down. The next one full level down main key level is the S1 level. So this would be your scalp exit here, regardless of how many contracts you're trading. Now, as you can see here, it hit it on the low wick of the candle. So we're going to give the price on the low wick touch as well as the candle close that backed off. The 66.65 at the money is 36.80 on the low wick candle touch of S1. That's $790 profit per option. The 66.60 out of the money on that low wick candle touch 34.30, the $850 profit per option. The 66.50 on the low wick candle touch $789 profit per option, as it was at 29.50. Now on the candle close where it had backed off, if you got out then the 66.65 was 35.88, so that's $698 profit per option. The 6660 was $33.20, that's $740 profit per option, and the 6650, $28.30, that's $669 profit per option. Okay, we'll be going to another screen here to look at the next trade, but just a preview to the next trade is, as you can see here on this 9:36 a.m. candle, we have a cross above, close above the bull bear key price level. This also is within range for a trade taken off the bull bear key price level. So this is a bullish entry signal for a trade off of this level, as it is within the acceptable range for the BBKPL level. Also, the next candle, the 938 candle, is also within the acceptable range for this trade. So you also could have entered on this trade. However, if you did that, you'd be paying a little bit more for the options than you would on the close here. Now, it's important to keep in mind that if you did not take this, if you did not get out here and you were doing a regular trade, what we term as a regular trade is you're looking for at least a minimum 1.5 level move in your favor. As you can see, that would have been getting all the way down to this midpoint here, one level, and then the half level, the midpoint level, mid S1, S2. So it did not reach that. However, we have the context here of this gap down with the odds of a gap fill being higher because of this particular scenario we have in today's session. However, if you were holding on for a regular trade, then you would have gotten stopped out, whether you use the tight stop loss or the standard stop loss. The tight stop loss, you would have gotten stopped out here, and then the standard stop loss, you would have gotten stopped out here. If that was the case, and that was the trade that you did take and you got stopped out, and instead of having a profit here from closing out at the scalp, you instead had a loss here, then your next trade opportunity would have been taking a bullish trade off of the R1 level. As you can see here, we have a close above here. Also, this candle here right afterwards is still within range for the acceptable range for this R1 bullish trade. And then if you had taken that trade, your standard stop loss would have been the first midpoint below R1, this level here. And then you would have turned on in the user control panel the QL below R1 if instead you wanted to use a tight stop loss on this bullish trade off of R1. Okay, this other information here will be on the next screen, so we will just move on to this screen now. Okay, so here's that same comment box here, 9:36 a.m. cross above, close above BBKPL bullish entry. That's this candle here. Here's the 9:38 a.m. candle here, which was still within the acceptable range. So if you missed this one, then you could have just taken a trade also on this, as it's still within the acceptable range. Also keep in mind, as we stated at the beginning, that you can take bullish and bearish trades off of each of the main key levels that this indicator provides. And that also, even though the 9:30 a.m. opening candle trade is part of the daily key levels trading strategy with this indicator, it is an optional part. And as I said earlier, many traders prefer for the initial shakeout to get out of the way before they enter a trade. So in that scenario, if you were waiting for the initial shakeout, then you would have not done this trade, and then your first trade that you would have been considering after the initial shakeout was this entry here. Okay, so now we have the reverse of the other trade that we started out with. We still have the same process for figuring out what are the three options that we have on this particular trade. Again, this trade is a bullish trade off of the bull bear KPL level. So our at the money strike is going to be the strike closest to the bull bear KPL of 66.6734. So that is going to be the 66.65 call option. Then So we're going to look up because this is now a bullish trade. So the first midpoint level above 66.76.86. The closest strike to that is going to be the 66.75 call option. And then the furthest out of the money we can consider on this trade is going to be the R1 level, the strike closest to this level, 66.86.37, which that strike is going to be the 66.85 strike. Just going back real briefly to one point I made a few minutes ago, that if you were stopped out on this initial trade because you were looking for a 1.5 level move and you were holding on past the scalp and didn't close out and you were stopped out here, then you had a trade opportunity here as a bullish trade on R1. So in that case, if you were taking a bullish trade off of R1, then you're at the money standard play for that particular trade would be the closest strike to R1, 66.85, and then your out of the money, first out of the money option would be the closest to this, which would be the 66.95 call option, and then your furthest out of the money you could consider would be the one closest to this full level above in the direction we're trading off of this level on a bullish trade, 67.0539, so the 67.05 call. Okay, so the price on this candle close here, the 9:36 a.m. candle, for the 66.65 at the money, 0DTE, $32.30. First out of the money strike, 66.75. On the candle close, 26.90. Furthest out of the money, 66.85. Price on the candle close, 9:36 candle, 22.40. Now here, this is a comment box reiterating what we brought up earlier. One level move in your favor for scalp only trades, 100% closeout on any scalps. Then we have what we call, with this indicator, a regular trade, a 1.50 level minimum required move in your favor. Once you have reached the minimum required 1.5 level move target for a regular trade, then you have the following options. Either 100% closeout, regardless of how many contracts you're trading, or adjust your stop loss on all to break even, or break even plus a 10 to 15% profit buffer on top of the break even. Or if you're trading multiple contracts, meaning in this case trading 3 or more as opposed to just trading 1 or 2, then you can close out 70 to 90% of them and adjust the stop loss on the remaining runners to break even, or break even plus a 10 to 15% profit buffer. Now keep in mind that when you have your trade entry, your initial stop loss on your trade entry is level based. So on this trade entry, our tight stop loss on this entry is the QL below the level we're trading, QL below BBKPL. Our standard stop loss, if you prefer using that, is going to be the first midpoint below the level you're trading on the bullish trade, mid BBKPLS1. On the initial trade we show you on the previous screen, it was a bearish trade on the opening candle. So on that bearish trade is the exact opposite. Still the level we're trading from, however, the tight stop loss in the bearish trade is the first QL above, and then the standard stop loss is the first midpoint above on the bearish trade from this level. What's important to also know is that the stop losses on the initial trade entry are price level based, whereas any stop loss adjustment you're doing on a regular trade is going to be based on the price of the option, not a level. So your only level based stop losses are going to be on the initial entry of a trade. Once a trade moves on a regular trade in your favor, 1.5 levels, then you're switching to a price-based stop loss based on the price of the option. So for example, if you had this option, once it's gone 1.5 levels in your favor, if you're not closing out all of your contracts and you're instead either scaling out, and because you have multiple contracts and you're doing a stop loss adjustment on your remaining runners, or you're just adjusting the stop loss on all your contracts, then break even would be the price that you paid for the option, or break even plus a 10 to 15% initial profit buffer means you're adding 10 to 15% onto this price. So for example, 32.30, between 10 and 15%, 10% would be basically $3.22. So you could just round it up to 350 and say 35.80 as an example. So the 10 to 15% is more of a zone. When you're thinking of it in your head doing the stop loss adjustment, you can just basically round up or down accordingly in order to make it simple and more expedient. Okay, then at each succeeding level move in your favor, each succeeding level meaning midpoint level and main levels, after the initial minimum required 1.5 level move in your favor, then you have the same options decisions, these here, to make at each succeeding level move in your favor, which we will show you here in a second as it moves through these different levels past the 1.5 level minimum move. Now, these YDC, YDH, YDL, PMH, and PML levels also come into play here, because after the 1.50 minimum required move in your favor has been met, then in addition to any midpoint level and main level that's in the direction after the 1.5 level move, any of these levels that are also in the direction of the trade after the 1.5 level threshold has been met, those are also under regular trades another waypoint for all of these decisions to make here for any closeout or stop loss adjustment. And as we can see in today's session, that is what occurred because of where these are positioned in relationship to where the trade met that threshold. If you already adjusted your stop loss at the minimum 1.5 level move in your favor, then at each additional move in your favor, if you do not want to close out all the remaining contracts when it hits another level in your favor beyond that, then you would add an additional profit buffer at each level move in your favor on any remaining contracts. The 10 to 15% is only the amount at the initial 1.5 level move in your favor. Okay, so now let's go through how this trade is worked out. 9:44 a.m. candle, the R1 hit, scalp only. Again, we're looking for a one level move in our favor for a scalp. This is the level we're taking the trade from. One full level, one full main level above is the R1. Hits the R1 here, the 9:44 a.m. 2-minute candle. Scalp only, 100% closeouts. Price on the candle close, 66.65, 39.25. That's $695 profit per option. 66.75, 32.60. That's $570 profit per option. 66.85, 27.40. That's $500 profit per option. So if you're just doing a scalp only, you'd have a scalp here, you're out. And you have this scalp trade and you're out. And now you can look to see if you want to take another trade off of another level, such as taking a trade, a bullish or bearish trade off of any of the other main or R or S levels as the session progresses. However, if you're doing a regular trade, you're still in this trade at this point from taking the entry here Or if you took the entry here at the 9:38 a.m. candle, remember that if you did that instead of taking the entry here, then you'd be paying a little bit more than these prices here. Okay, so the very next candle, as you can see, we hit mid R1, R2. That is the 1.5 levels from the level we're taking the trade from. That's one level, now another half level. So this is the minimum required 1.5 level move for a regular trade. So this is where you have all of these different options now as to what you can do of your choice. The prices on the 9:46 a.m. candle close are the 66.65, 45.30, that's $1,300 profit per option. The 66.75 was 38.20, that's $1,130 profit per option. The 66.85 is 31.80, $940 profit per option. Then we have a move up to the next main level here, the R2 level. Now this is a 2-level move from the level we took the trade from in our favor. This is what is known as the minimum ideal 2-level move for a regular trade. What do we mean by minimum ideal move versus minimum required move? Well, the minimum required move is the trigger for the threshold being met for a regular trade. What we mean by ideal level move is that in normal volatility, let's say low to moderate normal volatility, generally that's going to be generally about 80% of the sessions you normally see in a normal year on SPX out of the 250 to 255 sessions that there are in a given year. So most of the time, within an average year, about 80% of the sessions are going to be low to moderate normal type volatility. And a 2-level move is going to be from the level you're taking the trade from. A 2-level move is going to be typically the extent of the move in those volatility environments, with sometimes moving to the 2.5 level. Whereas in an increased volatility environment, say a high to extreme volatility environment, and today would qualify as a higher volatility environment than normal because the options were a lot more expensive, the IV is the implied volatility is a lot more expensive than normal. So this is not extreme volatility, but this is high volatility. So in a high volatility setting, then you're going to see more moves in the 3 to 4 or 5 or even 6 level ranges or above. And if you have very extreme volatility, then you can see moves up to 10. Now this particular indicator, the V2.0, actually does have 10 levels above, so it actually has R1 through R10 and below S1 through S10. However, on default, only the R1 through R6 and S1 through S6 are enabled. So in the user control panel, if we find ourselves in an extreme volatility market environment, such as we saw with the COVID pandemic that lasted for several weeks, or we had the 2007 2008 market meltdown from the Bush era, where we had the financial crisis and the real estate crisis and all that. We had extreme volatility during that time period as well. Those would be the kind of time periods where, the V2.0, you simply would turn on those additional levels 7 through 10. Okay. So on this 958, the prices on the candle close, $66.65, $50.40. That's $1,810 profit per option, $66.75. $42.20, that's $1,530 profit per option. $66.85, $34.93, that's $1,253 profit per option. Next, we have the next level move up here, which it goes to mid R2, R3. Now that's a 2.5 level move. But it also hits the YDL level. And as we mentioned before, after the minimum required 1.5 move, if any of the YDC, YDL, YDH, PMH, and PML levels are in the direction of the move in your favor after, and they appear after the minimum 1.5 level move in your favor, then those are additional waypoints for decision. It just so happens that the YDL level was extremely close to this midpoint level. So in this case, there's only a 30-cent difference. So it took out both of those levels here in this 1038 candle. And in this 2.5 level move now for a regular trade, now you have all the same decisions to make again. The prices on this candle close to 66.65 is now 66.07. That's $3,377 profit per option. The 66.75 haul 54.89. That's $2,799 profit per option. This furthest out of the money 66.85 0DTE call 48.98. $2,658 profit per option. As you can see here, it's holding after the popping above, holds YDL and the midpoint level on this candle here, and then resumes. Then here at the 10:44 a.m. candle, we have the pre-market high getting hit. Not only hits, it closes above it. On this candle close, on the hit of the PMH level, the 66, and you have still all the same decisions to make because this, of course, is all occurring after the 1.5 level move in our favor, which happened down here. $74 on the 66.65 call, that's $4,170 profit per option. 66.75 call, $65, $3,810 profit per option. And the further side of the money, 66.85. 55.08, that's $3,268 profit per option. And as you can see in the very next candle, it goes and hits the YDC, yesterday's daily close, slices through that, and also hits R3 in the same candle. So now that is a 3-level move on a regular trade. So here's the level we took the bullish trade from. 1 level, 1.5 levels, 2 levels, 2.5 levels, now 3 levels. The prices on the candle close 66.65 is now $80.93, $4,863 profit per option. The 66.75 is $71.78. That is $4,488 profit per option. The 66.85 is $62.03. That's $3,963 profit per option. Now, as you can see here, after hitting this level, it is now backed off to the PMH level with this wick touching it here. And then we try to get some stop loss hits through here. So we have a little fake out here by the market makers before resuming upward. And we hit the R3 level again here, testing it, and these two candles as the wicks came all the way down to the R3 level and bounced off. And then we have this move up over the next several candles to where it finally hits mid R3, R4. So again, each succeeding level move in your favor, midpoint and main level, you have a decision to make after it hits the 1.5, if those are beyond the 1.5 level. And then also these levels here, if they happen to be in the direction after the 1.5 level. So this is a 3.5 level move in our favor now. Price on the candle close, 66.65 call, $99.80. That's $6,750 profit per option. 66.75 call, $90.10. That's $6,320 profit per option. And the 66.85 furthest out of the money is all the way up to $80.80, $5,840 profit per option. Okay, so that is going to do it for today's video. If you like today's video, please hit the like button. And if you would like to see more videos, we also put out videos on various trading topics from time to time. And if you'd like to be notified of those videos or other session videos on SPX, or we also have daily key levels indicators for other symbol types as well. So we have separate indicators for them for stocks and ETFs, Forex and crypto, and then also futures. And we also have, for those who like to trade the NASDAQ index, we have a NASDAQ NDX index options indicator. So with this end of this video here, we will have an offer for you for a discount on our indicator. So for you taking the time to watch this video today, you can send us an email at daytradinggps@gmail.com and request a discount promo code to purchase the indicator. All of our indicators, including this SPX indicator that we went over with today, are sold on a one payment for lifetime access basis. So you would make one payment for the SPX Daily Key Levels indicator, and then you have lifetime access to that indicator, which also includes any updates we make to it in the future at no additional charge to you. And then if we come out with any additional versions that have more features in the future, which we are planning on releasing the 3.0 version of this indicator very soon, which will have some substantial new features added to it, and the price of the indicator will be going up at that time. So if you already have the indicator, then you will be getting the 3.0 at no additional charge because you have lifetime access. If you don't have the indicator, then you can still purchase it today at the current price, request the promo code, and get a significant discount off of the current lesser price. And then when the V3.0 comes out, you will not have to pay the price increase because you've already got the indicator, so you'll be entitled to get the 3.0 version as well as any versions we come out with in the future for this particular indicator with additional features in the future. So again, thank you for taking the time to watch this video today. Again, as I mentioned earlier, if you'd like to see details on other specific topics about this indicator, you could simply click on the link in the description of this video, which is the Google Drive link. It'll take you to a Google document, and there will be other descriptions of topics, other specific topics that we go into more detail on, a particular topic concerning this indicator. One of those happens to be there are two different types of trade entries, one being a regular trade entry and the other being a more conservative trade entry, which takes additional confirmations, and we go over examples of both of those and show examples of bullish examples of both of those as well as bearish examples of both of those. And there are other various detailed topics on certain topics about the indicator as well as in the description of this video, there's also a section on other SPX trading videos that are a lot longer than this video that go into more detail than we went over today. So if you'd like to see those, you can simply click on one of those other SPX trading session videos. So again, thank you for taking the time to watch this video today. We appreciate you supporting the channel, and hit the like button if you like the video, and hit the subscribe button if you would like to be notified when we post new videos. So again, thank you for watching. Have a good weekend, and we wish you much prosperity in your future trading endeavors.